For the average retail investor, the market is experienced entirely through the ticker. Success feels inextricably tied to the daily, chaotic fluctuation of price. This is Peter Lynch, one of the most successful mutual fund managers in history. His core assumption was radically different. The daily stock price is the least useful piece of information you can track, yet everyone obsesses over it. A stock's price simply tells you what other people thought the company was worth 5 minutes ago. It tells you about how many units the company ships, its debt load, or if its margins are expanding. To generate actual asymmetrical returns, you have to completely ignore the ticker and isolate the underlying fundamental earnings engine. To achieve that systematically, we are going to build a strictly defined 3-tiered fundamental sieve. The goal is to catch what Lynch termed 10-baggers, equities capable of returning 10 times your initial investment. This framework operates in 3 sequential stages: qualitative sourcing at the top, business typology classification in the middle, and rigorous quantitative stress testing at the bottom. The entire structure requires you to completely tune out macroeconomic noise. Inflation projections and interest rate guesses are irrelevant here. We are looking exclusively at the microeconomic realities of individual businesses. By applying these filters unemotionally, we strip away market panic and hype, leaving only the structural conditions required for exponential corporate growth. The first tier of the sieve actively rejects where everyone else is looking. If a company is a heavily covered Wall Street darling, operating in a media-hyped industry, it fails the filter immediately. We are looking for the exact opposite: companies with incredibly dull, unglamorous operations, like cardboard manufacturing or waste management, or companies possessing names that sound entirely forgettable. This handwritten note from a study of Lynch's methods outlines a critical heuristic. If you find a stock with little or no institutional ownership, you've found a potential winner. A lack of analyst coverage is the blind spot allowing assets to remain mispriced. You validate this further by looking for secondary signals. Corporate spin-offs often create newly independent companies that institutions automatically sell off without analyzing. Heavy insider buying by management is another stark indicator that the people running the boring business know something the market doesn't. The most lucrative opportunities are structurally hidden. They exist in niches that professional analysts are either restricted from buying due to their size or simply too embarrassed to pitch to their clients. With a hidden company isolated, we move to the second tier, the typology matrix. You have to correctly classify the business to determine the correct rules of engagement. This list details the 6 distinct categories Lynch used to classify equities: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Stalwarts are massive, established companies growing earnings at a reliable 10 to 12% a year. They provide a vital stabilizing force in a portfolio during market downturns, but they will never multiply your capital tenfold. For that scale of return, you need the fast growers. As the text explicitly notes here, this is the land of the 10 to 40 baggers. These are small, aggressive enterprises actively expanding at 25 to 25% annually. Conversely, you must recognize the unique trap of cyclicals, companies in industries like auto manufacturing or chemicals. Their earnings rise and fall in predictable macroeconomic patterns. Early detection of where the business sits in that cycle is the only variable that matters. If you demand 25% growth from a stalwart, or fail to accurately time your entry on a cyclical, you are applying the wrong mathematical expectations to the asset. Accurate classification prevents systemic valuation errors. We push the categorized company through the final, tightest tier of the sieve, the quantitative stress test. Here, we apply hard balance sheet math to validate the narrative. The baseline valuation rule is simple. Fair value is achieved only when a company's price-to-earnings ratio sits in perfect equilibrium with its earnings growth rate. If a company grows at 15% a year, a PE of 15 is fair value. For dividends, add growth rate to dividend yield, dividing by the PE ratio. A result under 1 is poor, while 2 or higher is highly attractive. Next, analyze debt architecture. Long maturity funded debt is vastly safer than fragile short-term bank loans. You also have to check the physical reality against the accounting. This note highlights the ultimate hidden danger. When inventories grow faster than sales, it's a red flag. A business manufacturing products that are simply stacking up unsold in a warehouse is about to face a violent collapse in margins. Finally, you scan for capital misallocation. Highly profitable companies frequently destroy their own value by using cash paddles to acquire entirely unrelated, lower-margin businesses, a trap Lynch termed diversification. A pristine balance sheet, confirmed by strict mathematical parity between price and growth, forms the only true armor an investor has against macroeconomic shocks and market panics. Selecting the right equity is only the mechanical half of the equation. Holding that position long enough to actually realize a 1,000% return requires brutal psychological endurance. Active daily trading operates in direct opposition to this. It is a mathematical friction trap that generates constant tax liabilities and institutional fees, while rarely outperforming long-term compounding. During routine market corrections, the instinct to sell will be overwhelming. This passage outlines the necessary response. The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. You stand by the stock as long as the fundamental story of the company hasn't changed. All the rigorous financial filtering from Tier 3 is entirely useless if you lack the conviction to hold through volatility. Exit triggers must be as systematic as the entry criteria. For a stalwart, the rule is mechanical. As noted here, I buy for 30–50% gain, then sell and repeat the process with other undervalued issues. For fast growers, a dropping share price does not justify an exit. You sell only when the internal mechanics degrade, when the PE ratio completely detaches from the growth rate, or when inventory buildup signals a collapsing market. If those fundamental metrics remain solid, the ultimate operational role is complete inaction. Once the fundamental thesis is validated, you sit relentlessly and motionless. True asymmetric returns are never achieved through constant trading. They are the mathematical reward for filtering ruthlessly, categorizing accurately, and waiting with absolute patience.